Hey there, I'm Amy Northard, the accountant for creatives, and today we've got some important tax information to discuss, specifically about a concept known as pass-through entity tax, or PTET. It's a topic that's been generating quite a buzz lately, so if you're a business owner or entrepreneur, you'll want to pay close attention. So first things first, what exactly is pass-through entity tax, or PTET? Well, PTET is a state tax designed to benefit pass-through businesses like S-corporations and partnerships. Now, I know it might sound a bit counterintuitive, a tax that helps you save money. Stick with me and I'll explain. The story begins back in 2017 when the Tax Cuts and Jobs Act was passed, which put a $10,000 cap on the yearly state and local tax deductions that individuals can claim on their federal tax return until 2025. This cap is known as the SALT cap. Now, to bypass this limitation, some states have introduced a new tax, with IRS approval that allows pass-through businesses to pay their taxes through their state's business tax return instead of their individual tax return. Because the SALT cap doesn't apply to the amount the business owner pays in PTET, that amount becomes deductible on federal taxes, and that's how a state can actually help pass-through entities save money on their federal tax returns. But here's the tricky part, folks. PTET is a state-mandated tax, and each state can put its own unique spin on things. Depending on your state, electing to pay PTET can usually allow you to do one of two things. One, you can claim a refundable tax credit, or two, you can exclude your share of the business income on your individual state tax return. And if your business operates in a different state than where you reside, it can get even more complex. To navigate this maze, my best advice is to consult a CPA who can decode your state's tax laws and determine what's best for you and your business. Now, not everyone can pay PTET to save on federal taxes. In general, if you own an S-corporation, a partnership, or an LLC taxed as a partnership, you can elect to pay PTET if your state offers this option. However, if any of the owners of your business are a trust, C-Corp, or own other pass-through entities, none of the owners may qualify for the PTET election. Again, this varies depending on your state's specific rules. So how do you make a PTET election? Well, you guessed it, it varies by state too. Some states require an annual election, while others lock you into the decision for at least 3 tax years once you make it. The method for making the election can also differ. Some states have physical forms to fill out, some allow you to elect PTET on your tax return, and some require online submissions. Each state has specific deadlines tied to their estimated tax payment schedules as well. Now the big question is, which states have pass-through entity tax? As of late summer 2023, the following states and jurisdictions either have enacted or are working on enacting PTET. These are the places where the potential tax savings opportunities exist. Keep in mind that some states don't have personal income tax, so they won't have PTET. But before jumping on the PTET bandwagon, make sure it's the right choice for your business. Consult a CPA to fully understand the process, the laws, and implications. And if you decide it's the right move, follow your state's guidelines for making the election. Done correctly, PTET can indeed help you save on your federal taxes, so don't miss out on this opportunity. And that wraps up today's discussion on pass-through entity tax. Remember, tax laws can be complex and are ever-changing, so always seek professional advice tailored to your specific situation. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit that notification bell so you'll never miss an update. Thanks for watching, and we'll see you in the next video.